Let me start with a simple but uncomfortable question. What does money mean when confidence in currency is no longer stable? Gold and silver prices are not moving in isolation. They are responding to a deeper shift in the global economic system. When investors ask where these metals will be trading in 2026, they are really asking something more fundamental. How much trust will remain in paper money, debt-driven growth, and central bank control? That is the lens through which this discussion must begin. Gold has always functioned less as a commodity and more as a mirror of monetary stress. When real interest rates are low or negative, when debt levels rise faster than output, and when geopolitical uncertainty increases, gold responds not with volatility but with persistence. The first hook is this: gold does not predict crises, it reflects them. As global debt continues to expand and fiscal pressures intensify, the conditions that historically support higher gold prices are becoming structural rather than temporary. By 2026, gold pricing is likely to reflect a world where central banks remain constrained. Tightening monetary policy aggressively risks destabilizing governments and financial markets, while easing reinforces currency debasement. This policy trap strengthens gold's role as a neutral reserve asset. Central bank accumulation of gold, already a notable trend, signals declining confidence in reserve currencies and rising demand for assets without counterparty risk. Silver operates under a different but increasingly powerful dynamic. It is both a monetary metal and a critical industrial input. The second hook is here. Silver is no longer priced purely as a precious metal, but as a strategic material. Demand from renewable energy, electronics, and advanced data infrastructure continues to grow, while supply remains constrained by geology and underinvestment. This dual role introduces upward pressure that is less sensitive to short-term economic cycles. By 2026, silver prices are likely to reflect scarcity rather than speculation. Industrial demand does not retreat easily, especially when tied to long-term infrastructure and energy transitions. At the same time, silver's monetary appeal strengthens during periods of inflation and currency uncertainty. This combination creates a pricing environment where pullbacks are shallow and long-term floors rise steadily. Another hook lies in investor behavior. As traditional portfolios struggle to hedge inflation and volatility, gold and silver increasingly function as strategic allocations rather than tactical trades. This shift changes market dynamics. Prices are supported not just by fear, but by structural reallocation of capital seeking preservation rather than growth. Looking toward 2026, gold and silver prices will be less about speculative targets and more about economic signals. They will reflect a world adjusting to higher debt, constrained policy options, and persistent inflationary pressures. In that environment, these metals are not simply assets, they are measurements of trust. And where trust erodes, gold and silver tend not to whisper, but to speak clearly through price. Gold's price behavior over the coming years cannot be understood through short-term charts or speculative sentiment alone. Its movement is anchored in structural monetary conditions that have been building for decades. The first hook is this: gold does not rise because economies are failing. It rises because monetary systems are being stretched beyond their design limits. When debt, currency creation, and policy intervention become permanent features rather than emergency responses, gold responds not with spikes, but with repricing. Global debt levels now exceed what can realistically be serviced through growth alone. Governments roll over obligations rather than retire them. Central banks absorb risk through balance sheet expansion, and financial markets are conditioned to expect intervention during stress. These conditions suppress real interest rates, even when nominal rates rise. Gold historically performs best in such environments because it competes not with cash yields, but with confidence in monetary discipline. When discipline weakens, gold strengthens. Here is the second hook: gold reflects loss of trust, not fear. Fear produces volatility, loss of trust produces persistence. Inflation that remains elevated despite policy tightening, repeated fiscal deficits justified as necessity, and currency dilution framed as stabilization all contribute to a slow erosion of belief in fiat systems. Gold captures this erosion quietly, functioning as a reference point for what money is worth when promises accumulate faster than production. By 2026, these dynamics are unlikely to reverse. Structural drivers such as aging populations, rising interest burdens, and geopolitical fragmentation limit the effectiveness of traditional policy normalization. Even when central banks signal restraint, markets recognize the constraint beneath the rhetoric. This recognition embeds higher baseline demand for gold, not as a hedge against collapse, but as insurance against gradual devaluation. Another hook lies in global synchronization. Monetary excess is no longer isolated to one economy or one currency. When multiple reserve currencies face similar pressures, gold's role as a neutral asset becomes more pronounced. It does not depend on policy credibility, fiscal discipline, or geopolitical alignment. That neutrality gains value precisely when coordination breaks down. Gold also benefits from the asymmetry of risk. If inflation persists, gold preserves purchasing power. If growth slows and policy eases, gold benefits again. The scenarios that weaken gold are narrow, requiring sustained real yield expansion and credible fiscal consolidation, both of which remain politically and economically difficult. In this environment, gold prices into 2026 are less a forecast of crisis and more a reflection of an economic system adapting to its own limits. The trajectory of gold prices toward 2026 is inseparable from the narrowing policy space facing central banks. This is the first hook worth confronting directly. Monetary authorities still possess tools, but they no longer possess freedom. Every policy choice now carries costs that extend beyond inflation control, binding gold's valuation to institutional constraint rather than market speculation. In theory, central banks raise interest rates to restrain inflation and lower them to stimulate growth. In practice, decades of debt accumulation have distorted this mechanism. Higher rates increase government borrowing costs, strain corporate balance sheets, and threaten financial stability. Lower rates, while supportive in the short term, accelerate currency dilution and asset inflation. Gold benefits from this imbalance because it thrives not on policy action, but on policy limitation. Here is the second hook: credibility matters more than intention. Central banks may signal resolve, but markets evaluate feasibility. When inflation persists despite tightening, or when rate hikes are quickly reversed in response to market stress, credibility weakens. Gold responds to this erosion of belief. It rises not because policymakers are incompetent, but because their options are constrained by the very system they stabilized for years. Another critical dimension is real yields. Even when nominal rates rise, inflation-adjusted returns often remain low or negative. Gold does not compete with headline rates, it competes with purchasing power preservation. When holding cash guarantees erosion over time, gold becomes a rational alternative rather than a speculative one. This dynamic is particularly relevant as governments prioritize debt sustainability over price stability. The policy trap is intensified by political realities. Central banks may be institutionally independent, but they operate within societies that resist prolonged economic pain. Sharp tightening increases unemployment, suppresses asset values, and provokes political backlash. Over time, these pressures shape policy behavior. Markets learn that central banks will tolerate higher inflation rather than sustained contraction, reinforcing gold's strategic appeal. Global interdependence further limits autonomy. Aggressive tightening in one major economy strengthens its currency, but destabilizes others through capital flows and debt stress. This creates pressure for coordination or restraint, both of which reduce the effectiveness of unilateral action. Gold, unbound by national policy, absorbs the resulting uncertainty. As these constraints persist, gold's role evolves from a defensive asset to a structural component of monetary balance. Its price reflects not panic, but realism about the limits of control in a debt-saturated world. Central bank behavior in the gold market reveals more than any policy statement or press conference. The steady accumulation of gold by monetary authorities is the first hook that demands attention. Central banks do not buy assets for momentum or narrative, they buy for resilience. When institutions tasked with defending fiat currencies quietly increase exposure to a non-yielding, non-liability asset, the signal is structural, not tactical. Over the past several years, central banks across both emerging and developed economies have increased gold reserves at a pace not seen in decades. This shift reflects a reassessment of risk within the global monetary system. Gold carries no counterparty risk, no default exposure, and no political conditions. In an environment where sanctions, financial fragmentation, and debt saturation are growing concerns, these characteristics gain strategic importance. Here is the second hook: central bank gold purchases are defensive, not speculative. These institutions are not chasing price appreciation, they are insulating balance sheets against currency volatility and geopolitical leverage. As reserve portfolios diversify away from overconcentration in a single currency, gold emerges as the neutral anchor. This process unfolds gradually, but its impact on demand is persistent and price supportive. Gold accumulation also reflects declining confidence in the long-term stability of reserve currencies. Persistent fiscal deficits, expanding central bank balance sheets, and rising geopolitical tensions undermine the perception of neutrality once associated with dominant currencies. While no alternative fiat system has fully replaced them, gold functions as a bridge asset, accepted globally without reliance on policy credibility. Another hook lies in signaling. Central banks are acutely aware that their actions shape expectations. Quiet accumulation avoids public alarm while reinforcing internal risk management. Over time, these flows reduce available supply in open markets, tightening conditions without creating volatility. The effect is cumulative rather than dramatic, supporting higher price floors. This trend also introduces asymmetry into the gold market. Central banks are price-insensitive buyers, focused on allocation targets rather than entry points. Their demand does not retreat during pullbacks and does not accelerate during rallies. This stabilizing presence dampens downside risk while reinforcing long-term valuation. By 2026, continued accumulation suggests that gold will remain embedded in reserve strategies, not as a legacy asset, but as a modern hedge against systemic uncertainty. When the institutions responsible for managing currency stability choose gold as protection, the message is implicit but powerful. Silver's price outlook toward 2026 cannot be separated from its evolving identity within the global economy. The first hook is this: silver is no longer behaving like a secondary precious metal. It is functioning as a strategic input whose demand is tied to long-term structural trends. Unlike gold, silver carries a dual character that reshapes its pricing dynamics, part monetary signal, part industrial necessity. On the monetary side, silver benefits from the same forces that support gold. Currency debasement, negative real yields, and declining confidence in fiat systems revive its historical role as a store of value. Yet silver's lower price point and higher volatility make it more sensitive to shifts in investor psychology. When inflation concerns intensify, silver often accelerates faster than gold, not because it is safer, but because it is more elastic to changing expectations. Here is the second hook. Silver's industrial demand is no longer cyclical, it is structural. Renewable energy, electrification, advanced electronics, and data infrastructure rely on silver's unique conductive properties. These sectors are not short-term trends. They represent multi-decade transitions supported by policy mandates and capital investment. Demand generated by these industries does not retreat easily during economic slowdowns, creating a floor beneath consumption. Supply dynamics further amplify this effect. Silver production is largely a byproduct of other mining activities, limiting the industry's ability to respond quickly to higher prices. Even when demand rises sharply, supply remains constrained by geological realities and long development timelines. This rigidity introduces upward pressure that is less responsive to traditional commodity cycles. Another hook lies in silver's undervaluation relative to its utility. Historically, pricing often reflected monetary sentiment more than industrial necessity. As industrial usage expands, that imbalance becomes harder to sustain. Markets gradually reprice silver to reflect its role in physical systems rather than purely financial narratives. Investment behavior reinforces this shift. As portfolios seek inflation protection beyond conventional assets, silver increasingly serves as a leveraged expression of hard asset demand. Institutional participation, while smaller than in gold, adds depth and persistence to price support, particularly during periods of monetary stress. The convergence of monetary appeal and industrial indispensability creates a unique pricing environment. Silver is not pulled in opposing directions. Both forces now align. This alignment reduces downside risk while magnifying upside sensitivity, embedding higher long-term valuations into the market as 2026 approaches.